All right. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. Guys, in this particular session, we are doing one question on the practice of consolidation. Now, consolidation is one area that is, almost in every exam, consolidation is one topic which is, some way or the other, it is tested heavily. Most of the times, most of the students get consolidation question in their CRQs. Even if they do not get a question in their CRQs, one way or the other, through either MCQs, through either, MTQs, this topic will be tested heavily. And that is why we aim to practice a lot on this particular topic. All right. So here is another question. This is a very good question, and this is not from your past paper. This is a different kind of a question. But I'm very sure that once we do this particular question, we should be in a much better position from where we are now. So let's make sure that we practice it very clearly. Examiner says, the name of the question is Tazel PLC, by the way. Examiner says on 1st January 2011. By the way, you see this date 1st January 2011, and at that point in time your mind should go towards the year end, and your year end is 31st December 2011. So you see that this 1st January 2011 date is the start of the year date. So it says that at 1st January 2011, Tazel PLC held 80% of the $1 ordinary share capital of Salden Limited, its sole subsidiary. So as I see it, you have a subsidiary, right, with a holding of 80%, and its name is Salden. Examiner says on 1st April 2011, that is after 3 months during the year, within the year, your year end is 31st December 2011, and your examiner is talking about 1st April 2011. Your examiner is saying on 1st April 2011, Tazel PLC acquired 30% of the ordinary share capital of Tata Limited. On 1st April 2011 means during the year. During the year, Tazel PLC acquired 30% of the share capital of Tata Limited. Now, you have acquired 30% shares in Tata Limited. So, this must be your associate, right? This must be your associate. Make sense? So, your subsidiary is Salden, whereas your associate is Tata. Given Tazel PLC significant influence over Tata Limited, the profits and losses of Tata Limited accrue evenly over the year ended 31st December 2011. Examiner says extracts from draft financial statements of the three companies for the year ended 31st December 2011 are shown below. Now, three types of P&L are provided to you. One is for Tazel PLC, one is for Salden Limited, and one is for Tata Limited. Now, guys, note this particular thing. As far as Tata Limited's P&L is concerned, as far as Tata Limited's entire profit or loss is concerned, it is irrelevant for us. I'll repeat that again. As far as Tata Limited's own complete P&L is concerned, it is irrelevant for us. Now, you would ask me, sir, why is it irrelevant for us? It is irrelevant for us because an associate is never consolidated. An associate is never consolidated. And just due to that particular fact, since Tata Limited will not be consolidated, this whole particular P&L, this complete P&L is not relevant for us. However, we are aware that whenever you have an associate, you are going to perform equity method accounting. You take share of their post-acquisition profit and include it within your own financial statements. As far as that is concerned, you will be requiring some part of the P&L for sure. Now, leaving Tata Limited's P&L aside, we have two P&Ls given in which you have revenues of both entities, one for us and the other one for subsidiary. Cost of sales, gross profit, operating expenses, operating profit. Then we have some investment income. In the P&L of Tazel PLC. We have some investment income in the P&L of Tazel PLC. Now, whenever you see investment income in the P&L of a parent company, you should always be mindful that there can be an intra-group transaction. There can be an intra-group transaction which is there in your P&L. For example, just imagine if S company gave a dividend, issued a dividend, then some part of that dividend would have also gone to the income of your parent company. You see, your parent company is 80% shareholder of your subsidiary. Now, if your subsidiary company issues a dividend, at least 80% of that dividend would come to my P&L, parent company's P&L. From individual set of accounts, that's fine. But as far as your consolidated financial statements are concerned, this is an intra-group transaction which would have to be eliminated. You should be beware of this fact that investment income has arisen in the P&L of Tazel PLC, and investment income also includes the investment in subsidiary. And when your subsidiary issues a dividend, some part of it might have also come into our P&L. And same goes for associate. If your associate issues some form of dividend, 30% of that amount would have come to our P&L. Again, we do not take dividend as an income in our consolidated P&L. Rather, we consider share of profit from associate to be included in our P&L. You should be beware of this. Make sense? Moving forward, we have profit before taxes of both entities, income tax expenses, and profit for the year. One more thing that you should keep in mind is that Salden Limited was our subsidiary since the year start. Remember, at 1st January 2011, Tazel PLC held 80% of the share capital in Salden Limited. So we had our 80% subsidiary since the beginning of the year. However, Umtata was acquired 3 months down the road. So Umtata's whole P&L will be done 9/12 for any particular working that we need to do. So Tata Limited might be prorated, but Salden Limited, that subsidiary company, will not be prorated in any case. Then your examiner provides you some data regarding statement of financial position. Equity balances have been provided to you, ordinary share capital of both entities, and then there are some retained earnings provided to you as well. Let's move on. Examiner has provided you some sort of additional information into the question. But before even going to the additional information, let's see what is the requirement. Now, for 18 marks in particular, one of the requirements is that you prepare a consolidated P&L for the year ended 31st December 2011. That we'll do. And the next requirement is you need to prepare an extract of consolidated financial position, presenting all figures that would appear in equity, including non-controlling interest. So there are two-part requirements into this question. One, you need to consolidate the P&L. We consolidate as if we owned everything, but we take care of cancellation of like items and intra-group balances. Then we also need to prepare equity section. For our statement of financial position. That equity section would include parent company's ordinary share capital, consolidated retained earnings, and NCI as well. So some part of balance sheet and more part of P&L we need to do. Done, noted. What's the requirement? Let's see what does note number 1 say. Examiner says, Tazel PLC acquired its holding in Salden Limited on 1st January 2009. That is 3 years back. 3 years back. The fair values of all identifiable assets and liabilities assumed by Tazel PLC at the date of acquisition were the same as their carrying amounts. At the date of acquisition, all fair values were equal to the carrying amount of net assets. Examiner says, with the exception of an intangible asset. However, there was some fair value adjustments required in intangible asset. With the exception of intangible asset, which was estimated to have a fair value of $10,000 in excess of its carrying amount. Can anybody tell me what is this? What is this? What is your examiner talking about? Anybody? Can anybody tell me what is this examiner talking about? And this would lead me to working number 1. What is this? examiner is talking about, guys, fair value adjustment. They are talking about fair value adjustment. They are saying at the date of acquisition, an intangible asset was estimated to have a fair value of $10,000 in excess of the carrying amount. That means there was an upward fair value adjustment, clear upward fair value adjustment of $10,000. Now, my question is that, all right, agreed, this is $10,000 upward fair value adjustment. But what does it have to do with my P&L? In P&L, you are not preparing anything for goodwill. Since you are not preparing anything for goodwill, how is a P&L question related to an upward fair value adjustment? Because for any fair value adjustment, the corresponding debit or credit is in goodwill, but we don't have to calculate goodwill. Then why is it relevant for us? Why is our examiner giving this to us? Very good, guys. Now, this relates to the fact that examiner has written that the intangible asset was assessed to have a remaining useful life of 8 years. Amortization of intangible assets is presented as an operating expenses. This is related to excess amortization. Very good. Excess amortization. Now, how do you calculate excess amortization, guys? 10,000 divided by 8 years of life. This is excess amortization per annum. This is excess amortization per annum. And guys, examiner has clearly said that to charge this under operating expenses. Charge this under operating expenses. Done. Now, there is one thing that I need you to be mindful of. Guys, in this particular question, we do not only have to prepare a P&L. The requirement is not for P&L only. We also need to prepare the equity section extract for SOFP. And that would mean we need to prepare a consolidated retained earning working as well. That would be part of our responsibility as well. Agreed? In this particular question, we will also need to prepare a consolidated retained earning working. And remember, whenever consolidated retained earning working is prepared, it is prepared for the purpose of balance sheet. And your balance sheet is always prepared as at. I will repeat myself again. Balance sheet is always prepared as at. As at means it will have a cumulative effect from start till the end. As at, starting from day one till now. So as far as your balance sheet is concerned, please listen to me very carefully. As far as your balance sheet is concerned, consolidated retained earning will have the impact of excess amortization, not for 1 year, for 3 years. We acquired this company 3 years ago. We acquired this company for 3 years ago. And from then till now, 3 years have passed, and consolidated retained earnings, since it is prepared as at from day one till till today, then that means it will have a cumulative effect of 3 years. That means the excess amortization impact will be multiplied by 3 for SOFP working or consolidated retained earning working only. Make sense? But as far as P&L is concerned, P&L is always prepared for the year. If P&L is prepared for the year, you will only include 1 year impact of amortization, nothing else. Let me know if this is clear to everyone. Let me know if this is clear to everyone. I want okay. Is it okay to everyone? Done? As expected, there was one guy, I repeated 2-3 times because I thought one guy would not understand. My gut feeling was correct, but still I'll have to repeat it again. Let's repeat it again. In this particular question, we also have to prepare a balance sheet extract. For that sake, we will have to prepare a consolidated retained earning. Consolidated retained earning is a balance sheet item. Balance sheets are always prepared as at. If balance sheets are always prepared as at means from day one till now. From day one till now. From day one till now. We acquired this company in 2009. Today is 31st December 2011. So from 1st January 2009 till 31st December 2011, these are total 3 years. 3 years. When we talk about preparing consolidated retained earning, the excess amortization that we are going to consider for the purpose of preparing a consolidated retained earning, it will have the impact of total 3 years. Total 3 years. Let me know if you understand. But P&L is only prepared for the year. That's why it will only include 1 year impact. Okay, my friend? Done. Thank you very much for understanding. All right. Examiner says S company's retained earnings at the date of acquisition were 160,700. Again, these are pre-acquisition retained earnings, and these, this 160,700 will help us in preparing a consolidated retained earning working. Examiner says during the current year, Salden Limited paid an interim dividend of 50,000. Oh, as we guessed it. Salden Limited during the year paid a dividend of 50,000. Let me say this is working number 2. Working number 2. Intra-group dividend. Right? Intra-group dividend. S company during the year paid a dividend of 50,000. Is everybody listening to me, Hanan? Are you listening to me? Huh? S company paid a dividend, issued a dividend of 50,000. Done. We are the parent company and we hold 80% holding in that particular company. That means when S company gave a dividend of 50,000, at least 80% of it would have come to us. I can write it down for you. Parent company's holding. So parent company's investment income would have included 50,000 multiplied by 80%. 40,000 parent company's investment income would have included 40,000 dividend received from S company. Is it clear? Now, my friends, this is an intra-group transaction. This is an intra-group transaction which needs to be eliminated. Which needs to be eliminated. Let me know if this is clear. This 40,000 should be excluded. Again, you do not need to write such narrations in your exam. I'm only writing so that you guys clearly understand. This 40,000 should be included being intra-group transaction. Done. Done. All right. Let's move forward. Examiner says Tazel PLC elected to measure the non-controlling interest in Salden using the proportionate method. Proportionate method. Remember, NCI is calculated as a proportion of net assets. NCI is calculated as a proportion of net assets. We will use this line a bit later, not right now. We will use this line a bit later, but remember, NCI is calculated as a proportion of net assets. Done. Moving forward. Examiner says at 1st April 2011. Okay. Is it visible now? Is it better now? All right. So examiner says at 1st April 2011. At 1st April 2011 means during the year. So at 1st April 2011, the date of acquisition by Tazel PLC, the fair value of Umtata Limited's assets and liabilities were same as their carrying amounts. Remember, Umtata Limited is not your subsidiary. So whether their fair value of net assets or carrying value of net assets are equal or not, it does not matter. It does not matter. You are not going to consolidate Umtata. Examiner has just written this note to confuse you a bit, but it does not matter. It does not matter. All right. Since 1st April 2011, note number 3, Umtata Limited has invoiced 90,000 of sales to Tazel PLC. Umtata has sold something to Tazel PLC. Umtata has sold something to Tazel PLC. Can I say, guys, this is working number 3, and this is intra-party transaction from A to P. This is intra-party transaction from A to B. From acquisition, since acquisition, A company has sold goods to P company worth $90,000, worth $90,000 at all at a markup of 20%. Why is this relevant to us? Yes, you are correct. We need to do working of URP on this. Examiner says 1/4 of these goods were still in Tazel PLC's inventory at the year end. So we definitely need to calculate the unrealized profit from this. First of all, let us calculate the amount of inventory because it was 1/4 inventory remaining, right? So 90,000 multiplied by 1 divided by 4, 1/4 or 25%. This is 22,500. The amount of unrealized profit or URP can be calculated as 22,500 is the value of inventory, whereas the markup was 20%. If markup is 20%, the normal cost would have been 100%. So how do we calculate profit in the case of markup? We discussed in our earlier class as well. Divide by 120, multiply by 20. 20 is the profit percentage. We need to eliminate the unrealized profit. So divide by 120 and multiply by 20, we get the unrealized profit amount of 3750. But remember, this is often one of the mistakes that every student does. I don't want you to do this. This is one of the most common mistakes that everybody does, is that you adjust the whole unrealized profit. No. In the case of associates, only share of URP is adjusted. Guys, please try to understand. You only take a share of a company's profit in your own financial statements. So if there is any unrealized profit, only share of that unrealized profit needs to be eliminated, because in the first place, you are not consolidating an associate fully. So only a share of unrealized profit needs to be taken. We had 30% shareholding in Umtata, and that means 30% will be the share of URP as well, 1125. We will adjust this. Do you guys remember what was the accounting entry? What was the accounting entry to be made in the case of A to P? As far as I remember, the working was share of profit from associate company debit 1125, and then investment in a company was credited by 1125, right? As far as I remember. All right. So this is something that needs to be done. Let's move forward, guys. Anything else related to, yeah, let's start with note number 4, guys. Okay. Examiner says on 1st January 2011. Okay, so there is a question, sir. Won't we apply 9/12? No. There is a question, sir. Won't we apply 9/12 on associate? No. You know why, Ijaz? You know why? We calculate unrealized profit. We calculate unrealized profit on inventory. And inventory is not for the 9 months or for the 12 months. Inventory is always as at. Inventory is always as at, right? One answer. I'll give you the second answer. The amount of transaction of 90,000 it was already written since 1st April, Tata Limited has invoiced 90,000. So the 90,000 balance and the 90,000 sales that were done by A company to P company were only from 1st April 2011. Yeah. So from that particular sense, although it's not relevant since we calculate URP on inventory, but still, if you were to think like that in an examination scenario, still you would have been motivated not to further prorate 9 by 12. Understood? Is it clear? Okay. Let's move forward. Examiner says on 1st January 2011, Tazel PLC sold a machine to Salden Limited for $120,000. What is this transaction? Parent company sold a machinery to Salden for 120,000. This is working number 4, I guess. Yes, working number 4. Intra-group sale of NCA, and this is P2S, right? P2S, sale of NCA. Examiner says the machine had a carrying amount in Tazel PLC's accounting records of 95,000 at the date of sale. The carrying value of the item, the carrying value of the NCA was 95,000. It was sold internally to the subsidiary, sales value for 120,000. Therefore, the profit on transaction would have been 25,000. Agreed till here? Agreed till here? Now remember guys, we have studied in our classroom lectures as well that in the case of sale of NCA, there is some realized portion in the form of excess depreciation recorded by the buyer. That portion of the profit is realized, so we do not consider that. And rest of the portion is always unrealized. And we need to adjust that. Is it clear? Yeah. Examiner says the estimated remaining useful life of the machinery was reassessed at the date of sale as 5 years. Depreciation on plant and machinery is presented in cost of sales. Guys, please try to understand. An item which was valued at 95,000 in the books of P was sold to S on a value of 120,000. So one group company charged 25,000 worth of profit from S company. Now S company would have partially realized the excess amount of depreciation on this balance. The 95,000 item was received by S company with a value of 120,000 now. So they would have charged excess depreciation on the excess amount of asset given to them. From the group point of view, the asset was originally 95,000. S company received this item with a value of 120,000. That means they received 25,000 extra value on the asset. Since this transaction happened on 1st January 2011, that means start of the year, S company would have realized at least 1 year of excess depreciation in its books of accounts. And when you consolidate P&Ls, that would be netted off already. Make sense? One party parent company would have realized a profit. One party parent company would have realized a profit on this transaction, whereas S company would have recognized excess amount of depreciation on the buying of this asset. Both will get netted off. At the time of consolidation, but not equal netting off will be done. Tazel PLC have recognized 25,000 worth of profit. Salden Limited would have only realized partial amount of excess depreciation. Examiner says the life is 5 years, so we will divide it by 5 years. And that means the realized portion is 5,000. The realized portion is 5,000. The remaining is still unrealized even after consolidation. That needs to be eliminated. This unrealized profit needs to be eliminated. in cost of sales. In cost of sales. Let me know if you understand. Let me know if you understand this clearly. I want an answer from everyone. Hanan, I'm waiting for your query. Done? Everybody done? So there is some realized portion and there is some unrealized portion. The unrealized profit needs to be adjusted and it will be adjusted in cost of sales as is written by your examiner. Done? Let's move forward. Examiner says at 31st December 2011, which is the year end, Salden Limited had received 45,000 S company. Your examiner is talking about S company. At 31st December 2011, S company had received $45,000 in deposits from customers to secure the purchase of its latest electronic game, which went on sale on 1st February 2012. Your S company, please try to understand, your S company received $45,000 as deposits from your customers. And this was advance deposit deposited by your customers for a game which was launched on 1st February 2012. That is after the year end. After the year end. Salden Limited, which is your subsidiary, recognized this amount in revenue for the year ended 31st December 2011 and deposited the money in a separate deposit account. Is it correct? They did bank debit revenue credit. Is this correct? According to IFRS 15, revenue can only be recognized once the performance obligation has been satisfied, not when money is received. This money is not, this obligation is not satisfied. It was satisfied after the year when the game was eventually launched and the game was given to their customers. Basically, your S company has misstated their revenue. Working number 5, I can write misstatement of revenue. Yeah. Misstatement of revenue. So revenue of 45,000 from books of S company needs to be reversed. Agreed? Does everybody agree on this? Is it clear to everyone? Give me a yes or a no. Is it clear to everyone? Revenue of 45,000 needs to be reversed. Needs to be reversed. Okay. All right. Now let's go for the last note. Examiner says at 31st December 2010, which is the last year end. 2010 is the last year end. An impairment loss of $15,000 in respect of goodwill arising on Salden was recognized. They are saying last year, not this year. Last year, there came an impairment of goodwill for S company. Let me ask you a question. We need to prepare P&L for the year. We need to prepare P&L for the year. Then why is our examiner giving us the impairment of last year? Does it make sense? We need to prepare P&L. Why is our examiner giving us impairment of last year? There must be a reason behind it now. What's the reason? Can anybody tell me what's the reason? Why has our examiner given us impairment of last year? No, not due to goodwill. No. You know why? Because additionally, we also need to prepare working of consolidated retained earning. And consolidated retained earning will include past 3 years impact since the date we acquired the subsidiary. This 15,000 is not relevant for this year. I know somebody might do an error. They would just read it hurriedly. Okay, an impairment loss came. They would write it in P&L as well. But no, this impairment relates to last year. It does not relate to this year. That's why it will not come into our this year's P&L. No. But still we have to prepare consolidated retained earning as well in this particular question. And there $15,000 will be relevant for us because consolidated retained earning is a balance sheet item, not a P&L item. Make sense? Is it clear to everyone? Let me know if it's clear to everyone. So $15,000 irrelevant for now, but relevant for us in a while. Make sense? Examiner says an impairment loss of $8,000 needs to be recognized in respect of Tazel PLC's investment for the year ended 31st December 2011. This is impairment of associate. This is impairment of associate. And since we are talking about so much about associate, why shouldn't we prepare a working, let's call it working number 6, for share of profit from associate? Let's prepare a working of share of profit from associate. Yeah. So how do you calculate share of profit from associate? Let me tell you. First of all, we will take S companies post acquisition PAT. Sorry, A companies post acquisition PAT. You see, Umtata Limited had a profit for the year after taxation of 204,600. Can you guys see? Umtata Limited had a profit after tax of 204,600. But remember, we are not going to take 204,600 completely. We are not going to take 204,600 completely. We only need to take post-acquisition impact. And that would be calculated as 204,600 multiplied by 9 divided by 12. Make sense? Make sense? So A company's post-acquisition profit of 9 months, But this entire profit does not belong to us. We are just a minority shareholder with 30% holding. We will say A company's holding. How much is it? 30%. So we will calculate share of profit from associate, and that is 153,450, which is already prorated 9 by 12, multiplied by 30% of our holding. So this gives us 46035. Is everybody clear on this 46035? I want an answer from everybody. Is it clear to everybody? Done? But guys, not so soon. Not so soon. It is not complete yet. It is not complete. Remember, we have to adjust two things from here. One was a transaction of A to P and URP of A to P 1125. And the other one is impairment of 8,000. Yeah. So I will write less URP A to P transaction. This URP needs to be subtracted from here 1125. Yeah. And then you also subtract impairment in a company, which your examiner told you this impairment is 8,000. So I will do minus 8,000. Done. So now calculating net share of profit from associate, which is the final answer. This will be this, and this. 36910. Is it clear to everyone? Let me know if it's clear. If it's clear, we'll move forward and prepare a consolidated P&L. Done. Excellent, guys. Very good. Okay, there's a question, sir. Not 8,000 multiplied by 30% for impairment. Let me clarify for it. It's written an impairment loss of 8,000 needs to be recognized in respect of Tazel PLC's investment in Umtata. My friend, this 8,000 impairment is only for our investment in Umtata. So you can call it, it's already 30%. Understood? It's already 30%. It's impairment of our investment. Make sense? All right. Now let us go and prepare a consolidated P&L, guys. I will need some space for it. So let me prepare some space. Yeah. I will write consolidated P&L for the year ended 31st December 2011. Yeah. Let's do some workings. Revenue. Okay, you consolidate as if you own everything. Remember, you consolidate as if you own everything. So how do you need to consolidate? It's very simple. You take sales of Tazel PLC 105,000 plus 864,900 and you simply consolidate. You consolidate as if you own everything. Now subsidiary was our subsidiary since last 3 years. So we do not need to prorate anything even. Simple. But one thing, please adjust. One thing, please adjust. Remember, there was 45,000 of excess revenue being booked by S company. This was an error that was done by S company. This needs to be adjusted. This needs to be adjusted. So how will we do that? Minus 45,000. This should be the working. Is it clear to everyone? 1,924,900 should be the answer. Is it clear to everyone? Done? Then let's talk about cost of sales. Again, these workings that I'm writing, it's only for the purpose of your own understanding. It's not necessary that you reproduce the numbers of your P&L in your spreadsheet in an exam. It's not required. I'm just doing it so that you understand this very clearly. 353,600 of parent company, 389,200 of S company. Plus, we need to make some adjustment in cost of sales. I remember that there was something related to US. This $20,000 of URP. This $20,000 of URP on NCA needs to be adjusted in cost of sales. So I'll write it down. Plus 20,000. All right. Cost of sales comes with a minus, so is equals to this number. Make sense? Is everybody okay? Gross profit, revenue, net of cost of sales, gross profit. There is a question, sir, should we point out the workings by the P&L figures? Not necessarily. I mean, I don't understand your question, to be very honest. What do you mean by pointing out? What do you mean by that? I'm not sure what do you mean by pointing out the numbers from your P&L numbers, but obviously this is calculated from P&L numbers. You do not need to rewrite. Okay, so you are basically saying, sir, do we need to refer to workings? Yes, if you do, that would be very good and convenient for your examiner. You should refer, like you should write working number 3 here, for example. Yeah, one of the cells you can write referring to working number 3 and things like that. You can do that. But again, if you have got less time in your examination, just forgo it. If you have time, do it. Okay. Then we have operating expenses. Okay. Operating expenses, guys, just writing the working for you guys here. It would be 290,400 plus 98650. And there was something else that had to be written off in operating expenses now. 1250 of excess amortization for the year. I think this was it only. Yeah. So this will be the working of operating expenses minus 390,300. Then guys, the next thing we have is operating profit, but not so quick. We will write two things here, investment income. We'll follow our own format, investment income, share of profit from associate. As far as your investment income is concerned, you see you have an investment income of 96,000. But remember, there was an intra-group dividend. There was an intra-group dividend that had to be eliminated, 40,000. So 96,000 minus 40,000 should be done. All right. All right. This is an investment income. Then you take share of profit from associate. As far as you can link your workings, you should do that. Put is equals to sign, move your arrow keys, go towards the working of working number 6 and go to the relevant cell 36910, press enter, and there you have it, share of profit from associate. In such a case where you link your cells to your working, you do not need to write referring to working falana and falana. You do not need to refer it particularly. All right. Because you have already linked it. Examiner can see your link. All right. All right, so we are done with this. Now we will have profit before tax. Profit before tax. This should be calculated as gross profit, netting off everything else. Yeah. I have got profit before tax of 864,710. Then I calculate taxes to get profit after tax. Yeah. Tax would be calculated as 167,000 plus 110,000. This is 277. And here I have a profit after tax of 587,710. Let me know if this is clear to you. Let me know if this is clear to you. Is this clear to you, guys? Done. Okay, now I have reached to profit after taxes. I will be preparing a working of profits attributable to, yeah. Profits are attributable to two parties, owners of parent company, and then there is NCI, and the total should be equal. Right? The total should be equal. 587,710. We always need to do some working for NCI. How do we do that? Working for NCI P&L. Yeah. The working is done is you first take S companies PAT. S company's profit after tax was 267050. First, you adjust this profit after tax for any necessary consolidation adjustments. Let me give you example. For example, there was excess depreciation during the year. Yeah. There was excess depreciation during the year. Remember? Excess amortization, to be very specific, regarding intangible assets. You need to adjust this excess amortization as well. Then one thing that I remember that was related to your subsidiary was the fact that your subsidiary had, recognized excess amount of revenue, to misstatement of revenue. This needs to be adjusted 45,000 because that 45,000 would have gone into your profit. You have recognized a revenue even before you have sold a product. So complete revenue would have inculcated your complete profit. That's wrong. So now we have S companies adjusted PAT for the year. Let me be very clear, for the year. And that is 267,050, 1250, 45,000, 22800. NCI's share in this profit. NCI's share in this profit would only be equal to 30%. So 22800 multiplied by 30% is 66240. Let me know if you guys understand this very clearly. 66240. Is it okay? Once you have got this 66240, this will be written here. And always remember, the parent company's profit attributable is always calculated as a balancing figure. This is always calculated as a balancing figure. There is no other way to calculate it. So 587,710 minus 66240, this should give you 521470. Is it clear to everyone? Is it clear to everyone? Everyone. Clear? So we just took NCI's share and posted it here. Owners of parent company's profit is calculated as a balancing figure. Now we have completed our consolidated P&L. Two more things that we need to prepare. We need to prepare a section of consolidated statement of financial position for equity, including NCI. So as far as your B requirement is concerned, equity of the consolidated financial statements will include ordinary share capital. Remember, ordinary share capital will only come of parent company because S company's equity, S company's capital is knocked off during consolidation. Remember, our investment and their equity is always knocked off, always knocked off. So ordinary share capital will only come of parent company, which is 3 million. Yeah. Then we will also need to have some consolidated retained earnings. And we will also need to have some NCI, which will then make our equity section, right? Okay, somebody said NCI's percentage is 20%. You are right. My apologies. My apologies. I did it wrong. NCI's percentage is 20%. Sorry. So it is corrected here. Clear? All right. Done. Then let's move forward. Let's prepare a separate working, and this should be working number 7 in our question. We are going to prepare a working for consolidated retained earnings. Yeah. Now we will prepare one column for parent company, the other column for S company. You remember the format of consolidated retained earnings now? We will start with retained earnings as per balance sheet date. Then we will subtract pre-acquisition retained earnings. Yeah. And thereon we will get post-acquisition retained earnings. Then we will make the relevant adjustments. Retained earnings as per balance sheet. Examiner has provided retained earnings as per balance sheet as follows: 468,400 and 395,300. Then we need pre-acquisition retained earning of S company. Remember, it was written somewhere here. S Limited's retained earnings at the date of acquisition was 160,700. So subtracting it from here. Yeah. Our post-acquisition retained earning will be as follows. Done. Then we need to make some adjustments to finally prepare our consolidated retained earning. We need to put all the adjustments that were relevant here. Like for example, there were some excess depreciation. Huh? Remember, excess depreciation we will consider for 3 years, not for 1 year. Excess depreciation or amortization, whatever you call. So we will take excess amortization of 3 years. Done. Then there was some share of URP from A to P. I will write less share of URP on sale of NCA. Remember? And this was A to P transaction. This was A to P transaction. Yeah. This was, sorry, inventory transaction. This was not NCA. URP on sale. So URP transaction from A to P, it needs to be adjusted from here. I'm sorry, it does not need to be adjusted from here. Sorry, I made this mistake. Why am I not adjusting this 1125 from here already? Because this 1125 I have already adjusted from here. God gave me this in my mind right here, right now. Otherwise, I would have done this mistake. Sorry. This 1125 is adjusted here already in the working of share of profit from associate. What I should be doing is I should be taking add share of profit from associate. Share of profit from associate is 36910, and this already includes the impact of any impairment and URP. Done. Done. What I was referring to is something separate. sale of NCA, whereby this has been a P2S transaction and there is 20,000 unrealized profit of 20,000. This will be adjusted from here. Then there will be another adjustment. There will be another adjustment that should be made. Less misstatement statement of revenue. Remember, S company had realized unrealized revenue, and due to which they would have increased your profits. They would have increased their profits. This is error. 45,000 of revenue reversal also needs to be recognized. I don't think there is anything else that we need to adjust. One thing, there is one thing more. I will write less impairment of goodwill. Again, thank God I remember this now. Impairment of goodwill. I need to do impairment of goodwill. Remember, our examiner wrote us that last year, the impairment was recognized against goodwill of $15,000. And I told you, this last year's impairment is at least relevant when we are preparing a CR working. Yeah. So this 15,000 I need to write somewhere here. Where should I write this impairment? In the column of P or in the column of S? Where should I write this impairment? In the column of P or in the column of S? Now, everybody would say that, sir, technically it is the goodwill of S company that you are impairing. Therefore, impairment of goodwill should be written off in the column of S company. But I would say no. You know why? Because guys, remember, NCI, Tazel PLC elected to measure NCI in Salden using the proportionate method. NCI was calculated as a proportionate method. That means the goodwill was proportionate goodwill. And we studied. Proportionate goodwill means that goodwill only belongs to parent company. Guys, if goodwill only belongs to parent company, then impairment also belongs to parent company. This is impairment to be written off for parent company only. CR debit, goodwill credit. This is it. Understood? Guys, is this clear? Post-adjusted retained earning. We will have some post-adjusted retained earning. Please confirm, is everybody understanding? I will take the sum of these cells and I will have these numbers. Let me know. Is it clear to everyone? Then I will write share of S company. The S company's post-adjusted retained earning is 185,850. Out of this, 80% belongs to the parent company. So the consolidated retained earning for parent company should be 470,310 plus 148,680. The consolidated retained earning is 618,990. All right, I'm just pulling it off in the equity section. This is 618,990. The next part is we need to do another working, which is for NCI, working 8, NCI. How do you calculate NCI for your balance sheet? First of all, you take NCI at the date of acquisition. NCI at the date of acquisition. Now, this is technical, guys. Please listen to me. NCI at the date of acquisition. Now, our examiner said that NCI will be calculated. NCI will be calculated. Remember, using proportionate method. NCI will be calculated as a proportion of net assets. The question is, how many net assets were there at the date of acquisition? Remember, net asset means equity. What was the equity of S company at the date of acquisition? Your equity will include share capital on that date, share capital at acquisition, retained earnings at acquisition. It will also include, my fellows, any upward fair value adjustment that was done at the date of acquisition. So guys, share capital of S company at the date of acquisition was 1.1 million. 110,000. Done. Retained earnings at the date of acquisition were 160,700. Yeah. And there was an upward fair value adjustment of 10,000, if you remember, of intangible assets. So the total net assets at the date of acquisition would have been 1,270,700. Is it clear to everyone? Please let me know if you understand. These are net assets of S company. These are net assets of S company. Is it clear to everyone? Now, examiner is saying that NCI will be calculated as a percentage of net assets. How do we calculate it? At the date of acquisition, net assets of S company were 1,270,700. NCI, somebody corrected me a while ago, NCI was 20%. So NCI at the date of acquisition would have been 254,140. Then NCI will be given a share of post-acquisition profits. They will be given a share of post-acquisition profits. Post-acquisition, S company made profits of 185,850. Out of those 185,850, 80% went to us. 80% went to us. That means 20% would go to NCI 37170. The total value of your NCI at balance sheet date would be 254,140 plus 37170. It is 291310. Is it clear to everyone? Our complete equity should be this 3910300. Let me know if it's clear to everyone. Is it clear to everyone? Guys, is it clear to everyone? We have completed this question. The question is complete, guys. The question is entirely complete. The question is entirely complete.